All right, if you're coming from part two, we have our Wayfair spread right here, which is currently sitting at max profit since both legs have expired worthless, and Wayfair is finished below $222.50. And let's take a look at the recap of this trade. We talked a little bit about technical analysis. Let's see how it played out. And as you can see, our trading channel right here intersected with the all-time high, and we thought there'd be a little bit of resistance when those two intersected, and it looks like that was true. It did break through the all-time high a little bit, but in the instances that it did break through, it came right back down and settled very comfortably below our price target of $222.50. Now for this example, it was pretty easy money. It never really was in danger of being max loss. The spreads that we set gave us a little bit of a cushion, and it really never went above that cushion that we gave it. So at this point, you're probably thinking, okay, that was super easy, pretty much printing money overnight, but what happens if the trade goes against us? How do we manage the trade? When do we close out? What do I know to look for so that I can avoid taking that max loss that we talked about when we opened the trade? Well, in this video, we'll get into that. Welcome to part 3 of our credit spread video series where we talk about managing the trade. This is the Hourglass Trader, where as time passes, we make money. Alright, so let's start with some basic principles. So one thing that I failed to address in the second video, which I got a lot of questions about, is when should you open the trade? So let's take a look at the trading week, 5 days right here. We typically like to open our trades on Monday or Tuesday with expiration on that Friday. So anything 4 to 5 days to expiration is typically the range we look in. And why do we do that? When we make a trade, whether if we're playing something up or if we're playing something down, it's typically because we have some sort of hypothesis about what way we think a stock is going to move. So let's say I think there's going to be a big sell-off on a stock and it's going to go down. I'd open a call spread, let's say on Monday morning for this example. That gives me the rest of Monday, Tuesday, and Wednesday just to kind of see if my theory was correct. Say we get to Wednesday and there's no sell-off and the price hasn't moved, I can get out of that trade because I was wrong about the fact that there was going to be a sell-off, and since the stock traded flat, I would even make a few dollars of profit on that trade. So typically for most of the spreads that we open, they're going to be on Monday or Tuesday so that we have a few days to monitor our trade and get out early if things go against us. So when do we close the trade? So the way I like to think about it is that you could get pretty much 100% of your max profit and split out over 5 days. That's 20% of max profit a day. And if these were to go in a linear fashion and you got 20% a day, it would look like this, where you're at 20% Monday, 40% on Tuesday, 60% on Wednesday, and so on. So if by the end of the day Tuesday you're up 60% on your spread, close the trade out, since that's 20% greater than what you would have if your profit were evenly spread through the week. Same goes if you were up 75% on Wednesday. And that's great if you're making money and the stock's going in the direction you want to go, but the question it probably brings up is, what if things don't go your way? So there are really kind of two options that I see. The first is closing the trade and just moving on, cutting your losses. When we open our trade, we have defined gain and defined loss, and we already set up our trades in the first place where a defined loss won't kill us. So if a trade really severely moves against us, we can just try our best to cut our losses and come in as far below that max loss as possible. Closing the trade and moving on is really best if your spread is in the money. If there's a severe move against you where your spread is so far in the money that you risk assignment and you don't really see it recovering, this is going to be the best option. And for the second option of rolling the strikes higher, this is a good idea if you think that your hypothesis is correct, but you need a little extra wiggle room with the short leg on that spread. So what you would do is you would close the current spread and open another spread at a higher strike price. So sometimes it can be kind of confusing at first when you see all this for the first time in slide format. So what I think is helpful is if we look at some of the trades I've actually made in the market where I've used these two different options to close spreads and manage spreads that went against me. Alright, so here we're looking at a chart of Facebook and about the 10 days leading up to their earnings on July 31st after market. So right here is July 30th, right before they announced earnings after market, and we kind of looked at this a little bit, analyzed what we thought was going to happen based off the recent spike in tech stocks and just some COVID considerations. We thought that Facebook was going to go down when they reported their earnings. So what we did, and I've got a screenshot right here directly from my trade log, was we opened a call spread with the short leg at 245 and the long leg at 247.50. So basically we were playing it below 245, and we did that because there was a little bit of resistance up in this area, and we felt that even if we were wrong and it went against us, that it would probably bounce back off of this line at 245 or 247.50, and we wouldn't have to suffer that entire max loss. So spoiler alert, you probably are aware, since we are talking about closing trades that go against us, we zoom out here and they killed earnings. No hesitation getting through that line that we set at 245 or at 247.50. In fact, there was almost even a little bit of a bounce off of it after hours. So the worst part about this for us is normally if a spread goes against you and it's Monday or Tuesday or Wednesday early in the week, you can close out and minimize your loss. In this case, Facebook reported their earnings Thursday after market. So with 1 day left till expiration on our spreads, we were pretty much dead in the water. So looking at and considering the two options that we had earlier, the best thing to do in this situation was just to get out of this spread for as little money as possible. So that's what we did. It opened at about $252, quickly jumped up to $256 as you can see right here, and at that point we wanted nothing to do with this because the only thing that could have saved us was a drop all the way down to $245, and after a strong earnings report, the likelihood of that is not very high. So another screenshot from the trade log here. We closed this right away, and we did it for a debit of $1.90. So this did result in a loss of about $1,400 on the trade, but our max loss on this trade was $2,000. So really what we did was we saved ourselves $600 by exiting the trade right at the beginning of the day when we could. And this is a really good example of when you realize that it's not likely the spread you opened is going to be remotely profitable, and how even though it's a Friday and we were on the day of expiration, there wasn't a lot of time left, we were still able to cut our losses and get out for a number below max loss. As you can see here, it finished the day around 253, 252, and we would have suffered the full max loss on the trade. So this is an example of a trade we made that went way against us. We utilized option one of just cutting our losses, and doing so and acting quickly in doing so saved us $600. Let's take a look at option two, where we rolled our strikes higher in an attempt to kind of save the spread and still pull some profit out of it. Alright, so right now it's the beginning of July. This is Tesla's chart, and it is currently July 10th when we're looking at this, and this is the 10 days leading up to July 10th. Tesla started off at $1,000, and on this Friday ran from $1,387 all the way up to $1,550. And if we thought the euphoria for Tesla was crazy right around here, it got to the point of being unbelievable when it got here. So at the end of the day on this Friday, we decided that we were going to play Tesla back down. So we were going to open a call spread. And what was tougher about this one was that this was an all-time high, so there really wasn't one definitive point of resistance that I could point to say, okay, it's been up here, this is going to be resistance. So what we did was we picked a psychological barrier and set the short leg of our spread at 1,600. So as you can see from this trade screenshot that we just brought in, we opened a 1,600, 1,610 call spread expiring the following Friday. So that would give us 5 trading days to see if our trade idea came true. And since we know that this is going to be a position where we roll the strikes higher, let's just throw this into a spreadsheet real quick for you so we could follow it. So right here we've got the 6 that we sold, 1,600, 1,610 call spread for a credit of 252. So we've got 6 of these sold. We think it's going to stay below 1,600. So let's go back to the chart and let's see how it played out. So again, this is Friday afternoon. So let's see what happened on Monday morning right here. And as you can see, as is the theme with this video that we have today, the trade went way against us. In fact, it went all the way up to $1,800 that morning. So at one point that spread was more than $200 in the money. And if we thought that Facebook spread that we talked about earlier was a danger of being a max loss, this was insanely dangerous. So what did we do? Well, we cut our losses on this one, but we're still not convinced that Tesla is going to stay this high. So we closed our initial spread for a debit of 525, and we'll throw this in here just to keep the tracking of the trade. So we're down $1,600 at this point when we closed that first spread that we opened. Again, if we got the max loss of 10, we'd be down $4,400. So we're definitely happy after a trade goes this far against us to get out at 525 and just keep that $1,600 loss. So what do we do now? Let's take a look at this little segment on Monday morning, and right around here is when we started to realize, okay, this thing's not selling off. It opened at around 1692 and then jumped even higher. So this is when we thought we need a bail, and that's when we bailed out of the 1600 spread and opened our next spread, which was going to be 1750, 1760, which we felt was another psychological barrier. And for this one, we'll bring the screenshot in again from the trade log. We got a credit of $3.45. But what we did here, whereas for the first spread we sold 6 of them, this one we sold 10. And let's tell you why. So if we look at this trade, we'll bring it in right here. We sold 10 of these at $3.45. So if we hit max profit and these expire worthless, we'll make $3,400. And this entire Tesla play, even though it went $200+ against us, will result in a profit of $18.12. Now you've always got to remember that there's downside risk where this can keep continuing upwards, could hit 2,000 or something insane, and we get a $10 debit to close, and that equals an $8.1 thousand loss. But once again, this is a situation where if it happened overnight, we probably think that we'd be able to close it for something similar that we closed the first spread to, and really would only be roughly a $3,000 loss. And from a risk management perspective, that's something we're okay with, because having Tesla sell off in accordance with our original hypothesis would put us back in a profitable position on the trade. So if we go back to Tesla's chart for the week, let's zoom back out. Let's see how it played out. And just like we thought, it really sold off hard the end of Monday. It pretty much ended Monday down around 1522, which was below our original spread, which was definitely something that's kind of frustrating. But at the same time, you could deal with that when you're making max profit pretty much on the second leg. Now, we didn't let this expire worthless because there is a little bit of a risk with letting such a volatile stock expire worthless. So we closed it out, and we could show the screenshot here for a debit of 10 cents per spread, which brought us down to a $3,300 profit for that spread itself. And for Tesla overall in the week, we still made $1,700. So despite the fact that when we were starting to play Tesla, it jumped up $200 against us, at the end of the week, we were still able to make $1,700, and that's the value in rolling your spreads higher and still trying to squeeze out a little bit of profit when a trade moves against you. So that's going to do it for part 3 of our credit spread series. We're going to have one more video coming as a 4th and final part of the credit spread series where we talk about additional considerations about risk, such as when what's listed as your max loss isn't actually your max loss, and that video will be coming pretty soon. But in the meantime, we've got all of our social media listed here. If you've got any questions, feel free to comment on this video or reach out to us on Twitter. We try to get all of our plays up there. And something important I want to point out is that we just started a Discord server. So if you're interested in having access to that, feel free to shoot us a message and we'll get you an invite link to that. On that Discord server, we pretty much continue to teach people the option strategies that we play. We talk about trade ideas and give alerts to trades that we're personally about to make before they hit Twitter. But that's all we got for this video, so until next time, this has been the Hourglass Trader, where as time passes, we make money.